Markets bouncing higher on the heels of the jobs report, and some of the biggest moves of the day are in the bond market. As we talked about, that 10-year yield closing in on 4%. We're joined by George Catrambone. He is DWS Group head of fixed income and head of trading. So as we look at this move here, was that your reading on today's jobs report as well? Is that 50 basis points now off the table, George, and that's what the market is trying to price in now?
Sure, good news was not good news for bond yields as they went higher. When you look at the constituency of the report, you're looking at healthcare, travel and leisure, government, all services sectors that are coming up and remain strong. So the problem for me was, and probably the Fed, the 3-month averages moved from 114,000 to 184,000. So that trend line changed significantly. It almost looks as if that plane that everyone's been talking about buzzed the tower, and the trend line looks like it's going higher. So I've heard a little bit about Governor Timorous in your opening there. and I think that's ultimately the question. It seems like he believes it's 25 basis points, but it seems like now it was premature for the Fed to actually cut 50 in July.
I mean, there was talk of course, George, about that this morning, some Monday morning quarterbacking. I give some economists a pass because some of the guys I was listening to, they said they wanted 25, so I think they were on record saying that. But did you look at that and said, you know what, the Fed may have made a policy error. They didn't need to do a supersized cut.
I think they were in front, and I think it's truly to call it a policy error, but the data didn't portend going 50 basis points at that time. And going into the blackout window, retail sales was still strong enough. CPI was actually kind of firm, and that's where I'm turning to the page next week to know whether or not it was actually an error. The question is whether or not inflation continues the downward trajectory, especially when that services sector and jobs at least rebounded today.
Well, and it's interesting, if you look at the Treasury market as one of the transmission mechanisms of the Fed, it hasn't come down that much, right? So yields have not come down that much, that is. So you could argue, even though they cut 50 basis points, there wasn't that much additional easing that hadn't already been priced into the market, maybe?
Well, economic conditions were already loose, and I think that's part of the problem when they actually did this. You had corporate earnings that were expanding, and I think that was the knock from those Monday morning quarterbacks a little bit that, again, the data didn't necessarily say we had to do an outsized cut. I think it was based very much on that July data that came out and surprised everyone. Maybe it was the jobs report, maybe it was the yen carry unwind, or maybe it was geopolitical. But you saw a race to treasuries, and ever since then, the positioning has been really crowded around front end now. And if you look at it since August, front end yields have moved quite a bit.
So is the base case then for you, George, you look at this report and think, okay, 50's off the table. They proceed cautiously unless we get some surprise in October.
Correct. It's still data dependent. I think Mickey Bowman is out there smiling this morning. I don't know if we're at first ascent in 20 years. So we may see more tack on at this meeting. But I do think at the moment, it's safe to say 25. That gets us to 1% for this year. And then a reassessment for next year. And this is a market that was set up for disappointment. And I think that's going to be the question as to where that neutral rate actually is and where we're headed.
Well, I guess I'm still trying to understand what was the risk in doing 50?
Sure.
What was that risk? What's the problem with them having done 50 now?
It wasn't warranted with the economic conditions, and ultimately there's a potential for a reacceleration of inflation. And
Does it look like that's what's happening?
We'll have to see next week, but there is a tacit admission, in at least our opinion, that the steepening that you see right now in the yield curve was that they were okay with inflation hanging around 2.5%. And I think if you really wanted it to slay the inflation beast, you could have been a bit more measured and going 25. I think that's what you're
How did, George, do you think the market reacts if they don't get the number of cuts they're expecting, but they don't get it because the economy's solid?
Yeah. Initially painfully, at least on the front end, and I think ultimately your trough or your neutral moves higher. So I do think eventually the curve does re-steepen in a more meaningful way. I think we're very flat right now, but in the short term you will see some pain and potentially even bond yields come out a little bit based on the interest rate move. And I would turn buyer on that, by the way.
And looking a little bit at the credit market too, you're not seeing a lot of signs of stress there, it sounds like.
No, I think, 10% of the CCC index last week moved out of distress territory. And that's been part of the problem. The story of 25 will be interest rates versus credit. And that's just a question.
Meaning what?
Meaning how much, based on how the market was priced for perfection, and bad news effectively was seen as good news to support both lower yields and corporate credit, and they've been able to issue. We had negative concessions last week. Everyone's been able to come to market and ultimately avoid that refunding wall. Based on how tight historical spreads are, there is room for widening. Interest rates will be part of that story. And ultimately, we'll see what earnings say next week as well. Bank earnings are out. Look at Ally Financial. They were the ones for pointing out consumer credit being a problem.
What would you be expecting to hear from those big banks, George?
Well, you would hope to hear, after seeing what we saw today, that everything kind of stays intact. You don't want to see more subprime stress, ultimately going more into the prime segment. That's where the issues will come from.
And does it seem like, I mean, you know, when Ally reported, that had to do with auto credit, right? Does it feel like there are those cracks?
It's been concentrated. Yep, it's been concentrated in auto. The problem is if that spiders elsewhere. And I think that's ultimately the question. And we're still a negative on consumer overall right now. Yes, we realize this report. Yes, we've looked at retail sales, but we still think there's still some stress to come, at least in credit card usage continuing to go up.
All right, we're going to keep an eye on that. Thank you, George. Appreciate it. Good to see you.